Hello, everyone. Excited to have you today. This is the Metals Innovation Initiatives Next Grants and Funding webinar. Very excited to delve in today into available state and federal tax credits and incentives, specifically talking about what's relevant to metals companies and talking about some particulars, Kentucky state funding incentives along the way. Before we get started, though, I just want to give a quick nod to our grants and funding consultant at MI2, Ruthie Caldwell. Ruthie, can you say a quick hello to everybody?
Yeah, hi guys. I'm Ruthie Caldwell, and I'd love to meet with you guys. I've met with a few of the metal company members so far, and I'd like to see how I can connect and maybe find some more federal funding for you. So please contact me at ruthie@visiongranted.com if you'd like more information. Thanks, Sam.
No problem. So I think most of you are familiar with MI2, but the Metals Innovation Initiative was founded in late 2022 with a mission to make Kentucky the destination for metals innovation. We're officially now a 501c3 nonprofit and working with a variety of metals companies, ecosystem partners, and state government on a whole set of innovation initiatives. If you visit mi2ky.org, you can find out about the 25 initiatives that we are currently working on, including several collaborative grant opportunities with multiple metals companies that match against those strategic priorities. But today, the story is about tax credits and incentives. And we're very fortunate to have the team from BDO join us today. First, I'm going to introduce Dave Malson, who is Senior Manager in BDO's Credits and Incentives practice. He has 16 years of combined experience as a tax professional in the industry and consultant, with a primary focus on identifying opportunities for clients in manufacturing, distribution, oil and gas, and energy. Prior to joining BDO, Dave worked as a property tax manager for a Fortune 500 manufacturing company and as a consultant in Ryan LLC's Complex Property Tax Group. Look forward to hearing from BDO today. I'm going to turn it over to Dave, and Dave's going to introduce the rest of the BDO team and get us started. Thanks, Dave.
Thank you, Sam. So good afternoon, everyone, and thank you for having us today. And thank you to MI2 for organizing this webinar. My name, as Sam said, is Dave Malson. I'm a senior manager with BDO's Credits and Incentives practice. Now, my team and I assist with state and local C&I opportunities across the country, including Kentucky. Anytime a client is hiring or making a large investment, we help to identify, apply for, and implement credit and incentive strategies to add value to your projects. We appreciate the opportunity to discuss incentives related directly to Kentucky. And in our experience, manufacturers have an easier time qualifying for some of these programs, but have trouble when it comes time to implement and realize the benefits. So today we will cover incentives, most applicable to the companies on this call. So here's our agenda today. We'll start out with state incentives, including the Kentucky Business Investment Program. And then we'll move on to federal incentives related to manufacturing and credit monetization. I won't give the full bios of everybody, but with me today are Mylea Koo and Brittany Niehaus from our C&I practice, and they will discuss the state and local programs. And we have Jesse Tsai and Drew Norris from our business incentive group, who will cover the federal side of incentives. Now, if after this presentation your company requires any assistance with the topics we discuss, please feel free to reach out. Our emails are provided in the bios. So now, in addition to tax-related incentives, one of our biggest savings opportunities for clients, especially manufacturers, comes from utility incentive programs. Since many of our clients are located in the Mid-South, we work a lot with the Tennessee Valley Authority Economic Development Group. Now, while not specific to Kentucky, we wanted to touch briefly on this opportunity since the zone does stretch into the southwestern portion of the state. Now, we have a lot of experience saving money for clients with these programs. We have helped many companies secure monthly utility savings as well as cash grants through TVA incentives. Now, the requirements for TVA programs are not too challenging to meet. We find that companies with operations within the zone are able to actually qualify based on employee retention and regular annual capital investment. We also find that most companies are not taking advantage of these programs. Now, based on your investment, your employment, your electricity demand and usage, you can expect savings from the Valley Investment Credit between 10 to 20% off your monthly utility invoice for up to 10 years. We have a lot of experience navigating through these programs, and we can provide the expertise needed to qualify for the highest savings and cash grant opportunities. Now, the earlier we get involved on any incentive strategies, the more benefit we can bring your team. So again, our emails are in the bio, and we would love the opportunity to meet and discuss incentives with anyone on the call today. So with that, I'm going to kick it off to Brittany, who will cover some of the Kentucky state incentive programs. Brittany?
Yes, thank you, Dave, for the introduction, and good afternoon, everyone. I apologize, my video is having some technical difficulties, but I hope you all can hear me well. As Dave mentioned, I'll start by giving a high-level overview of some of the top credit and incentive opportunities that are mostly available to manufacturing companies specifically in Kentucky. First, we have the Kentucky Enterprise Initiative Act, otherwise known as KEIA, and this program provides a sales and use tax refund for any taxes paid on things like building and construction materials used for real property improvements and or equipment used for research and development and data processing. To be eligible, a company must invest at least $500,000, and this can include spend for research and development equipment, acquisition of property, building materials, construction materials, property improvements, and things like that. The process to implement this incentive begins with applying and receiving approval first from the Kentucky Economic Development Finance Authority, otherwise known as KEDFA. Once approved, the company will typically enter into a signed agreement and will have 18 months from the date of approval to purchase materials that will essentially be eligible for the refund. After the project's completed, the company must then submit Exhibit A to KEDFA and Exhibit B to the Kentucky Department of Revenue. The DOR then verifies sales and use tax paid and will issue the final refund check to the company. Next is the Kentucky Inventory Tax Credit, which is a non-refundable tax credit for any taxes paid on inventory in the state. And this can be used to offset the Kentucky income tax and or the Kentucky limited liability entity tax for any taxes paid on inventory. To be eligible, a company must pay all property taxes timely, which would be on or before 12/31 of a given year, and it must be to a taxing jurisdiction within the state. And to take advantage of this credit, you must file Form TCS with the Kentucky Corporation Income Tax and LLET return. So next, we wanted to touch on some of the benefits that are specific to job training within the state. Both of these programs are administered by the Bluegrass State Skills Corporation, otherwise known as the BSSC. First is the Skills Training Investment Credit, and this provides a tax credit for any company that supports occupational or skills upgrade training. This credit can also be used against Kentucky income tax liability. It's equal to $500 per employee trained, and that can go up to a max of $75,000. And second, there's the Grant and Aid Program, which provides matching grant funds for manufacturing specific training offered to employees. The amount of this grant is equal to 50% of eligible training costs, up to the lesser of those training costs, $2,000 per employee, or again, a max of $75,000. Since these are both administered by the BSSC, the implementation and compliance process is very similar, which begins with applying and receiving approval from the board of directors to enter into a signed agreement. After that, the company must complete all required training within 1 year from the board approval. And then once all the training is completed, the company will submit all required documentation and any requests for reimbursement to the BSSC. The BSSC then reviews and will notify the company of final reimbursement or tax credit amounts. And finally, in our experience, these last two incentives are the most utilized incentives by manufacturing companies in Kentucky. And first is the Kentucky Reinvestment Act, or KRA, which provides a corporate income tax credit to companies with an eligible reinvestment project. And this credit can be used to offset up to 100% of corporate income tax liability and can be claimed for up to 10 years. To be eligible, the company must employ at least 25 full-time employees and make a minimum capital investment of $1 million for leased facilities and $2.5 million for owned facilities. Eligible costs can include manufacturing machinery, equipment, computers, furnishing fixtures, and any other assets that are installed by the company as part of the reinvestment project. The process to implement this incentive begins with applying and receiving approval again from the Kentucky Economic Development Finance Authority to enter in a preliminary agreement. This preliminary agreement sets forth the maximum incentives available and all of the requirements that the company needs to meet. The company must then complete the reinvestment project and receive final approval within 3 years of this preliminary approval or preliminary agreement. And then once the project's finally completed, the company will provide all documentation and support for the project's costs, and the final reinvestment agreement will then be approved by KEDFA. Once entered into this final agreement, the company must submit annual exhibits to confirm compliance each year with the agreement terms. So finally, we have the Kentucky Business Investment Program, otherwise known as KBI. And this has been one of the most popular incentive programs that we've helped a significant number of clients secure. And so to talk more in detail about this program, I will hand it off to Mylea.
All right. Thanks, Brittany. Good afternoon, everyone. It's a pleasure to be here with everyone today. And I'll be presenting a more detailed overview of the Kentucky Business Investment Program. You're going to hear me refer to this program as the KBI program throughout my presentation. We wanted to dedicate a little bit more time to the KBI program because, one, we've had a lot of success with this program with our clients. And then the other issue too is that we've seen a lot of businesses really struggle to capitalize on this credit, which, depending on the scale of your expansion project, can be a substantial amount of money that you're missing out on. And as I continue to go through this program, you'll see how involved it is to implement and why it's so important that you use the credits and capitalize them appropriately to make it worthwhile for you to pursue this program. First off, I'll be covering an overview of the program. I'm going to touch on eligibility, and then I'll also be going over benefit realization. So again, once you receive the award, how do you optimize your benefits? The KBI program provides credits to manufacturing businesses that make a qualified investment. And that qualified investment must be at least $100,000, and it needs to lead to job creation of at least 10 new jobs. Now, a qualified investment can be an expansion project, which might involve a physical expansion, such as adding additional space to your existing building, or it could just be the addition of a new production line, which requires hiring additional employees. So a lot of times when we talk about an expansion project, our clients will think, oh, we need to construct a new building, or we need to add physical space. But it's important to note that even if you're just adding an additional line, if it requires hiring at least 10 new employees, and if it will require, let's say, $100,000 in additional equipment, that could qualify you for the KBI. The KBI program may be approved for up to 10 years or 15 years if you're located within an enhanced county. And I will explain a little bit more about what an enhanced county is in just a minute here. It's important to note that the credits earned are refundable, and that it may be used against income tax or income tax withholding. Refundable credits in the credits and incentives world are highly sought after, because it could equate to cash back to your company. And a lot of the programs that we work with, because we work in all 50 states, so we've seen a lot of programs that will restrict their application to the company's existing tax liability. So you basically can't use it unless you have a tax liability. But with the KBI, that limitation doesn't apply to it, which means you can either use it against the two types of taxes that I just mentioned, so the income tax or tax withholding, or you can request for it as a cash refund, which makes this program highly attractive. And the key requirement to this program is that it has to lead to the creation of new jobs. So since this is a jobs-based program, the state does require that the wages and benefits offered to the newly created jobs, that they meet certain requirements. The state of Kentucky requires that the wages offered are at least 150 times the federal minimum wage. And then the company must offer at least one company paid benefit, and that benefit should be equivalent to at least 15% of whatever the required minimum wage is. I've got the wages listed on the slide here for you to reference, and you'll notice that the wages are fairly reasonable, especially for the manufacturing industry. Because we work with a lot of different programs, and sometimes we'll look at the wage requirements and just just be blown away because it's not reasonable. But for the KBI program, the wage requirements are fairly reasonable. And then if you're located in an enhanced county, these requirements are actually lower. I've got those listed on the slide for you as well. Next slide, please. Now let's talk about the enhanced counties. In a lot of states, states will offer incentives for investments in underdeveloped regions. And so these enhanced counties were established by the state of Kentucky to basically encourage development in these areas. And the state will usually identify these counties on an annual basis. They identify them based on 3 different factors, such as unemployment rates, levels of distress, and education attainment levels. I've got the link listed here for you to reference in case you'd like to check to see if any of your locations are within these areas. But basically, if you choose to invest in one of the blighted or troubled areas within the state, there's an additional incentive there because the wage requirements are a little bit lower. Credits are determined based on the wages that are offered to the newly created jobs, and those wages are multiplied by a predetermined rate. That rate is usually up, or it can be as high as 4% or up to 5% if you're in an enhanced county. And this rate will be clearly spelled out in your agreement. So once you have an executed agreement from the state, you'll have a good understanding of what your rate will be, which will be used to calculate your credit. And it's also important to note that this rate is negotiable during the implementation phase. So if you decide to engage us to implement this credit for your company, we will leverage our expertise and the specific details of the project to advocate or push for the highest rate possible. Any unused credits can be carried over from year to year, and they can be carried up until the end of the term. So none of the credits will expire until the end of the agreement. Also important to note here, there is an application fee of $1,000 to get the process started. And once the application has been approved, there's also an administration fee, which will be assessed. And the fee is a percentage of the total amount of credits that were approved. But it is important to also note that the fee is capped at $50,000. Now, often when we're discussing programs with our clients that have associated fees, most companies are initially deterred, and rightfully so, right? It's understandable. But I just wanted to make sure to emphasize that the potential returns from this particular program can be completely justifiable. We've secured like millions of dollars for some of our clients through this program. And when we are initially engaged, one of the first things we'll do is we'll actually prepare an analysis to make sure that your return will make it worthwhile for you to pay these upfront fees. Next slide. Credits are claimed on an annual basis, like I mentioned earlier, and they can be claimed after compliance reports have been filed. Now, that is true regardless whether you choose to use your credits towards income tax or withholding tax. And the first report that needs to be filed is the employment report, which is due at the end of January every year, and that's following the activation date in your agreement. And this report demonstrates that the company has met the job commitments, which are spelled out in the agreement. It also demonstrates that they've met the wage requirements and the benefit requirements. On top of that, there's another report that needs to be filed, which is the annual reconciliation of wages. And this report needs to be filed by March 15th. Now, and sorry, that's the March 15th of every year following the activation date as well. And what's kind of nice about this report is it also serves as the refund request. So if you decide that like, hey, we don't have a tax liability this year and we prefer to just get a check cut out to the company, then you can indicate that on this form. And once the form gets certified, then the check will be cut out to your company. This return will document the wages and the withholding amounts that have been paid to the employees throughout the course of the year. And a lot of times these reports may come off or appear to be straightforward, but in our experience, there are some subtle nuances to these filings that can make them challenging. And again, that's kind of where you may find value in what BDO offers, because if we're engaged to handle the compliance work, we'll review the employee data to make sure that the employees are working the required minimum number of hours required by the state. Because every state has their own requirements, and within the state of Kentucky, a full-time employee is required to work at least 35 hours. So our review will make sure that whoever you're claiming the credit for, that they're considered a full-time equivalent for the state of Kentucky. We'll also review their wages and benefits to make sure that they're hitting the state minimum requirements. We had one particular client who had to do their annual wage reports 3 different times because they could not get their system to pull the correct wages. So when they filed their reports to the state was unable to tie those wages back to the W-2 reportings. And so there was a lot of back and forth between the company and the state. But when BDO stepped in, we were able to help them configure their report to pull the appropriate data so that the annual rec would tie out to their W-2 reportings. We also had another client who had 3 different projects at the same facility. So we helped them with assigning their employees to each of the projects to make sure that they can maximize their credits. Now, once the annual filings are complete and they've been certified by the state, the credits may then be applied towards your income tax or your withholding tax. And if you want to apply that towards your income tax, you claim that when you file your income tax return, right? Or same with the withholding tax liability. Now, also, as I mentioned earlier, if this would be the time where if you don't have a tax liability, either with income tax or withholding, you can just say, hey, just cut me a check, right? Cut us a check for the amount. And that's what makes this credit so great. Sorry, I'm just having an issue here. Okay. Yeah. Now, overall, like this program is definitely one of the programs that is a little bit more involved. But again, because of the success we've had with this program, it's definitely something that's worthwhile. So if any of you are thinking about a possible expansion in Kentucky, please reach out to us. The earlier you get us involved, the better it is. We would love to help you structure your project to maximize your benefits for the KBI program. And with that, I'm going to hand it over to the Business Incentives Group and let them talk about federal incentives.
Oh, you already have the slides up. Thanks, Drew. Appreciate it, Mylia. In full agreement. Anytime you can get refundable credits at the state or federal level, it's definitely an attractive opportunity. But thank you for having us, and we appreciate MI2 to setting up today's presentation. As the state team mentioned, we are the federal counterparts to credits and incentives. So my name is Jesse Tsai. I'm a managing director, and I sit out of Washington, D.C. And with me, I have Drew Norris, a manager out of West Michigan. So we are here today to focus on the federal side of things, credits and incentives opportunity at the federal level. Before we move away from some of the state topics, I did want to mention that oftentimes when it comes to opportunities for especially manufacturers in Kentucky, oftentimes there are corollaries between state and federal programs. So the programs that Mylia just went through with KBI, if you are exploring KBI, it's worth exploring, are there federal counterparts to the same effective information. One program that I did want to highlight is the New Markets Tax Credit. It's not part of the renewable energy incentives that we're highlighting today, and just for lack of time, we aren't able to go through it in detail today. But the New Markets Tax Credit is a program that's been around for, 24 years now, since 2000. And effectively, it is a complex program, but it mirrors a lot of the requirements in KBI. It's a program that's meant to incentivize investments that have the outcomes of creating jobs and other community impacts. That is all to say, again, if you guys are exploring credits and incentives, it's very important to explore these holistically, because oftentimes if you're going to go through the work of exploring one program, it's worth exploring to see if you can leverage the same information, the materials, to maximize your opportunities. But with that, we'll get into the topic today, which is renewable energy incentives. Next slide. Actually, Drew, if you can go one slide forward. I'm going to take the next slide and go back. So just by way of background, Drew and myself, again, we focus on credits at the federal level, which pre-Inflation Reduction Act, really ran the gamut. It included renewable energy credits, which we're here to discuss today, but it also included other federal credits, including R&D credits, employee retention credits, the aforementioned New Markets Tax Credits, et cetera. The big milestone on the federal level really was the Inflation Reduction Act, which passed August of 2022. And with the Inflation Reduction Act, there was really two big changes that impacted federal credits. The first is just a sheer amount of new credits and expanded credits available. The Inflation Reduction Act, as you guys may have heard, really is the largest legislative package, not only in the renewable space, but arguably from a federal credits and incentives perspective as well. typically, when Drew and I do these type of presentations, we really have, 1 or 2 new credits a year to discuss, simply because it's pretty hard, as you can imagine, to get through credits and incentives at the federal level. But with the Inflation Reduction Act, really what we're looking at is over 20 new and expanded credit opportunities at the federal level, really geared towards renewable energy. The second big change is that these credits, staying with the theme of refundability, these credits are monetizable, meaning you can sell these credits for cash, or in certain instances, treat them as a refundable credit on your own return and get a payment from the federal government. This is a drastic change in terms of the federal landscape, because historically speaking, federal credits are not directly transferable or monetizable. So to the extent you are able to monetize a federal credit, pre the Inflation Reduction Act, it really was through specific structures that were set up in order to monetize these credits. And then there was limited circumstances where there were small batches of directly monetizable federal credits. So I'll go into some of the more relevant federal credits at the outset of our portion, and then I'll kick it over to Drew on the latter half to discuss the monetization of these credits. As you guys can imagine, I'm sure you guys have all heard it, Inflation Reduction Act is, all over the news, and really for the last year and a half, it's been the starting point for any conversation when it comes to renewable energy. For perspective, when this first passed, our job is to educate our clients in the firm about new legislative packages, including the Inflation Reduction Act. And I recall, early on when we were talking about the IRA, no one knew what it was, right? Every time they heard me talk about the IRA, they were very confused because they thought I was talking about retirement accounts. And so they kept wondering, why are the federal credits guys talking to us about our retirement accounts? But nowadays, a year and a half later, I mean, Drew and I are pretty much on IRA-related calls all day, every week, just because of how much activity has really picked up. So looking on the slide we have here, it helps to take a step back to understand, why do we have monetization now? Why did we have this drastic change in how we're going to treat federal credits? And it really has to do with the legacy of project finance in the United States. And so for background, developers of renewable energy projects traditionally have been focusing on solar and wind. And really, developers are in the business of developing these renewable assets to sell electricity. That's really the end goal, right? I'm a developer. I want to develop these assets so I can make money off of selling the electricity generated. But given that renewable energy for a long time was not a mature industry, there were no long-standing operating companies that had cash flow to finance these projects. And so the problem developers had to solve over the last 2 decades was really, if I have a project that is going to generate cash, how do I get myself through the construction period, right? If I don't have an operating business with cash flow to self-finance, how do I go about finding finance for a project that is going to be new, that expected to generate cash upon completion, but I need to get through the construction period? And so one of the solutions historically that evolved to solve this problem was through a concept called tax equity, which was how projects were financed predating the Inflation Reduction Act, pre-IRA. And what tax equity really meant was developers were entering into partnerships with tax equity investors, and effectively through various structures, partnership flips, sale leasebacks, inverted leases, they were having investors come in to provide capital for their projects, and then allocating the tax credits out to the tax credit investor through these complex structures. That was how renewable projects were financed for a very long time. Needless to say, it was very complicated, and it was let's call it less than efficient. the compliance requirements, the structuring. It was a very complex way to fund development of these renewable projects. And so for a very long time, the renewable industry had been advocating for a simpler way to find capital for these projects. And so with the Inflation Reduction Act, in addition to all the new credits and incentives available, there was that new concept of monetization. And so instead of having developers having to go and enter into complex partnerships or sale leaseback structures, et cetera, in order to find equity for their projects, these credits are now directly monetizable, meaning these credits specifically under the Inflation Reduction Act carry the characteristics that they are monetizable under a section called 6418. And again, for limited credits, a smaller subset of these Inflation Reduction Act credits, they are directly monetizable in the sense that you can treat them as a refundable credit on your return. This has the impact of greatly simplifying project structuring for developers of projects, but it also has a secondary impact in that taxable entities that have nothing to do with the generation of these renewable projects, now they have an opportunity to buy credits at a discount. So we'll go through what that looks like in detail later on, but Drew, if you actually go back one more before I hit 48C. What that has really meant is through these various projects, a lot of different credits are now being generated. We highlighted a few of these and we break them out in ITCs and PTCs because conceptually, federal credits for the renewable space are generally speaking either an ITC or a PTC, meaning they're an investment tax credit or production tax credit. The delineation is pretty straightforward. An investment tax credit is a tax credit that follows a capital investment. So if you are making a capital investment in charging stations, alternative fuel refueling property, energy property, doing certain instances of manufacturing, if you're investing capital, you may be able to get an investment tax credit, which is a tax credit based off of that capital investment. The production tax credit is a companion piece of the investment tax credit. Oftentimes, you can claim it on the same type of project, but you can only claim either the ITC or the PTC. The PTC is a companion version of it, where instead of incentivizing capital spend, it's incentivizing an outcome. So a PTC is a tax credit based on some type of activity. And as long as that activity is completed, regardless of what the capital investment involved with it, you get a credit off of that activity. So that's the PTC. We highlighted just a couple of key ITCs and PTCs as part of the IRA here. But generally speaking, there's a little bit over 20 new credits. And in addition, in 2025, so starting next year, we actually switched to a completely new regime where ITCs and PTCs, instead of the asset classes that we outline here on this slide, ITCs and PTCs actually go to what's called technology neutral. So in 2025, we're completely changing how we look at credits again. And instead of looking at these specific technologies, we're going to focus on investments or activities that have the effect of renewable energy, meaning you're generating electricity or doing some type of qualifying activity without regard to the specific technology involved. So we're going to focus a little bit more on the outcome. So that's going to start happening for projects after 1/1/25. With that, since we only have a limited amount of time here, I'm not going to go through all 20 credits and incentives, but we did want to focus on one in particular, 48 Cap C, because it's much more time sensitive. For the other tax credits that I mentioned, regardless of whether you're looking at it in a post 2025, so technology neutral, or this current year, IRA credits, barring an act of Congress, are probably going to be around for around the next 10 years. A few of the credits sunset a little bit sooner, a few of the credits sunset a little bit after. But generally speaking, the Inflation Reduction Act paradigm is here for the next 10 years. We did want to take some time today to specifically highlight one of the credits because it is very time sensitive, and that is the Section 48 Cap C investment tax credit. So 48 Cap C was a program that was first initiated back in 2009, and then there was a spillover round in 2013. Since then, it's relatively laid dormant, and then it was brought back as part of the Inflation Reduction Act. But the 48 Cap C investment tax credit is very unique in that it's a specific type of ITC, investment tax credit, that is application based versus a statutory credit. So for the most part, statutory credits, if you meet the qualifying activity, you're entitled for the credit. 48C is unique in that it is a federal discretionary program, which we don't see a lot of. The idea of bringing back 48C was, in addition to the 20 new and expanded credits and incentives, they wanted to bring about a program that had additional flexibility to basically gap fill situations where we want to incentivize certain investments, but it didn't cleanly fit into one of the other credits. And so 48C was brought back and funded with $10 billion in order to address kind of the gap fill. 48C at a very high level, again, it's application based, and it's meant for manufacturers that are supporting the renewable energy ecosystem in some way, somehow. Now, the downside of the program, again, it's discretionary and it's highly competitive, but the benefit is it is much more broad a program than your traditional Section 48 because it covers a lot more qualifying activities. Most relevant here is it covers the whole universe of processing, refining, and recycling critical materials. With the traditional Section 48 does not. You all might be aware of another companion credit called 45X. 45X is the PTC version of 48 Cap C's ITC, but 45X carries with it certain purification requirements when it comes to critical materials, whereas 48C does not. And again, 48C covers just a broader realm of activities. But at a high level, 48C it is application-based. It is jointly administered through the IRS and the DOE. And because it's following a lot of the DOE grant programs, they follow a lot of the structure that DOE programs follow. So that to me is a two-part process, a lighter concept paper, and then a more robust application should you be encouraged from the concept paper. It, again, was highly, highly competitive in the first round. It was administered over 2 rounds. For the first round, which should be announced by the end of this week, actually, $4 billion of the $10 billion was allocated out, and applicants requested over $40 billion of allocation. So it was oversubscribed by a multiple of 10 times. The application is very, very competitive. I would say advice for folks that are considering this for the next round, so the remaining $6 billion that should kick off very soon, make sure that you focus on the ancillary supporting parts of your project, not just focusing on the baseline qualification, so the recycling, processing, refining of critical materials or the production of clean energy technologies, but focus on the ancillary aspect. So that is the job creation, that is technological innovation, that is contributions to a U.S. supply chain. Within the notice, there's all these categories that are going to be considered. From the first round, we observed that a lot of clients focused a lot about their core activities and maybe didn't focus as much on the ancillary impacts. So for folks that are considering this for round 2, it's very important to consider what are the ancillary impacts. So job creation, innovation, supply chain contributions, et cetera. Again, because 48C is application-based, it is very time sensitive. We expect round 2 to kick off very soon, likely sometime in April. Reading the tea leaves, they'll probably want to administer the second round faster than they administer the first round. So beginning to end, the second round of the program might come and go within a period of 4 to 5 months. So it's very important that if this is something your organization is considering, that you act on it sooner than later. With that, I think I'm going to kick it over to Drew to handle the monetization of tax credits.
Yeah, thank you, Jesse. And so kind of transitioned into the credit monetization discussion, kind of how our team was brought into this conversation was fairly organic. Because Jesse mentioned, we sit on the federal credits and incentives team and see the renewable energy incentives that the Inflation Reduction Act offers. But what we saw here at BDO is we also have a large BDO corporate tax base that's not in the renewable energy industry that's asking, what is the Inflation Reduction Act? How do we participate in the new credit monetization provisions? And what does it look like to go through a transaction from start to finish? And so I think that's a great way to kind of talk through today. And we can use the 48 cap C credit as an example, just with those award announcements expected within the next week. And as Jesse mentioned, it's essentially a way to turn our tax credits into cash in the instance that we don't have sufficient tax liability to use ourselves. And really, while we aren't able to use that full dollar for dollar value on our own tax return, we're still able to generate near market or parity values by selling these tax credits through. We're able to use these tax credits. Jesse, you mind covering? I got something outside here.
No, no worries. I can cover this. So essentially, instead of using the credits themselves or allocating out to an investor in pre-IRA times, really what this is allowing a buyer to come in and provide that cash for the projects directly. And so for a government program to give our federal government some credit, it is a pretty eloquent way to solve for how do we finance these renewable projects without directly impacting the government fisc. And so really what it is conceptually, it is as simple as if a buyer has tax liability and a seller does not have tax liability, a seller is able to sell the credits that they generated to the buyer so that the buyer effectively steps into the shoes of the seller, and the buyer is able to tame the credits on their own return. Obviously, the buyer is going to want a return for doing so. And so generally, a buyer is obviously going to pay a discounted price. So you're not paying a dollar for dollar. But what we've observed to date is that the discount that the buyer is taking is not so far off from dollar to dollar. So generally speaking, sellers are getting 92, 93 cents on the dollar gross for the credit. So that doesn't account for transaction costs. But generally speaking, post IRA, a lot of these transactions are being done. We have seen a huge uptake in activity. I would say as of Q4 last year and continuing on in 2024. Transactions were able to be monetized after 1/1/23, but it really was towards the end of last year where this market of transferable credits has been more properly defined. So again, this is something to just be cognizant of, even if there aren't opportunities present today. Again, this paradigm of monetization of credits is around for the next 10 years. So it is important to understand these concepts that if you're generating a credit that you can't use because of your lack of tax appetite, you can sell these credits to a buyer that is able to use it for their own return, and then vice versa. If you are a taxpayer with federal tax liability and you may not be doing the renewable projects, there are credits out there and that you can go acquire these credits at a discount. For the buyer, the spread is not taxable. So in the example that we're showing here, the $8 million, so the spread for 92 cents on the dollar, that $8 million is not taxable to the buyer. And for the seller, the 92 cents on the dollar is excluded from gross income. So effectively, there is a tax neutral impact both for the seller and the buyer. Are we able to go to the next slide? So we have an example here. We just put up a very simple example of what it looks like. The example here we have, actually, can you go back one very quickly? The example we have here is a 40% investment tax credit. So using ITCs again, ITCs are credit off of CapEx. If there's 100 million of eligible basis, a 40% credit, you can generate a $40 million credit to monetize. Next slide. And so of that $40 million, let's assume that the developer, the credit seller, is unable to use that credit. They're able to sell, and in this case, we have as an example 93 cents on the dollar. So company B, which would be your third-party taxpayer that has nothing to do with the renewable project, they just want to buy credits for tax planning purposes. At 93 cents on the dollar, they're paying $37 million for the $40 million of credit benefit. There's always going to be a little bit of transaction cost to facilitate this transaction. It is a commercial legal transaction, but ultimately, potentially, the buyer could walk away with 2.7 million of untaxed benefit. So this runs through their tax provision. So for the buyer, effectively, instead of paying, 40 million of tax liability, they're paying 37.2 by way of doing this transaction, walking away with that $2.7 million benefit. And then again, their counterpart, the seller, they get 37 million of untaxed cash, and that 37 million could be used to help finance the development of the project or subsidize the costs of the eligible IRA project. So I think that takes us to the, sorry, go ahead, Drew.
Yeah, and sorry about stepping away. We had a storm blow through, but one of the things that's unique too about the credit transfer side is if we're a credit purchaser, if we're in the shoes of a credit purchaser, this isn't new cash that we have to ask our CFOs. We don't have to ask our treasurers for new cash. Really what it is from a commercial item is sellers have been agreeable to essentially transact around our quarterly estimated tax payment dates. So instead of writing our check to the IRS, we essentially reallocate that check to the credit seller just for a transaction efficiency standpoint. So it has been a very active provision since the passage of the Inflation Reduction Act and the proposed regs came out, and definitely has democratized access to capital.
Well said. Well said. Well, I think we want to leave a little bit of time at the end for any Q&A, both on the state opportunities and the federal opportunities. So maybe at this point, I'll just kind of open it up to the broader group in case anyone has questions.
I think we're good.
Well, I've got a question for y'all. As you see so many of these sort of new or first of their kind federal incentives programs going down here, what do you see as some of the biggest challenges for companies to take advantage of those programs? I know a lot of the companies that I'm working with, it is exciting yet daunting to see all these new programs that may not be familiar to anybody inside the company. So do you all have some kind of rules of the road or quick tips or tricks of what companies should especially think about as they're navigating a lot of these programs, the federal programs especially that are brand new?
Sure. I would say talk to your tax professional as early as possible because we didn't really have time to go through all the various credits. We covered 48 Cap C, which is one of 20. But one common theme through these new credit programs is that the rules for which you calculate the credit have drastically changed compared to pre-IRA. And what that means is pre-IRA, we had a pretty fixed program, meaning if you do this thing, you can look in the tax code and it'll tell you the exact credit amount you get. So if it's this is the year I installed solar, I can just look up the tax code and it'll tell me, here's the credit I get for installing solar in this year. Post Inflation Reduction Act, they drastically changed the credit rules across the board. So not just with the 48 Cap C program I mentioned, but with a lot of the existing credits like 48, 45. And now we have, instead of a fixed rate, a variable rate, meaning the credit rate that you get for these federal programs is very much facts and circumstances dependent. And so using an investment tax credit as an example, for most taxpayers, the credit could be anywhere from 6 to 50%. We used a 40% credit rate in our prior example, but very quickly, you start with a 6% base credit rate, then you have to meet certain labor and apprenticeship requirements to get you to a 30% credit rate. And then if you're eligible vendor, get to another 10%, so that's 40, and then another 10% for being located in certain census tracts. And so that is going to be project specific on a case-by-case basis. An identical project here using different vendors, subcontractors, the location could result in a completely different credit from the same credit being placed in service over here. The reality is the rules are pretty complex. So again, the rules of the road, I would, as soon as you have a project in mind that may be credit eligible, talk to a tax professional as soon as possible, because what you want to avoid, and we've seen this unfortunately, situations where, because most times when you look at credits and incentives, you kind of make the business decision and you come back after the fact to see what credits I can take for this business opportunity I have. You don't want to put yourself in a situation where if you're making a large investment, because you didn't select the right vendors or think about the contracts you had in place at the outset, you on the back end find yourself left with a 6% credit where you could have got a 40% credit had you done something a little bit differently. And again, because these credits are monetizable, meaning that they're worth potentially cash, by not structuring it properly at the outset, you're potentially leaving a lot of cash on the table. This is a lot more fun than talking about retirement accounts. I will say that. The early couple of months, there's quite a bit of confusion. So, I'm happy we've evolved to a point where we can have conversations about what the Inflation Reduction Act means. But yeah, early on, we had a lot of conversations about retirement accounts.
Well, really appreciate the time from the whole BDO crew joining us today. For those of you all who have joined, we will be, as long as everything goes according to technical plan, we will be archiving the recording of this. If you've got colleagues, other folks in your organization, or with other metals companies that you think would benefit from learning about these programs, we'll have that up on our website in the coming days and in our next newsletter. So just really appreciate the time, the attention, and the insights. I know you got contact information there from Ruthie and from the BDO crew. If anybody has trouble finding it, just email me or Nora or somebody else at MI2 and we'll put you in touch. So appreciate
Thank you
everybody.
very
Hope you have a
much.
great
Thank you
afternoon.
so much.
Thank you.